Good morning. It's the 13th of December, and this probably our. We've got one more webinar to go, I think, next week, Stuart, and then we're
playtime.
What's that?
It's playtime.
Playtime. Yeah, we'll take a well-deserved break. All right. So a lot's happening in the oil and gas space. Stuart, Woodside and Santos are talking about merging. What's going on there?
So we're in an unusual stage of world history. No one wants to admit that they like oil and gas, either from an investor's perspective or as a consumer. We haven't quite been there before, but what you get during times of either low prices or unusual market conditions is mid-sized companies merging together to create superpowers. We last saw this late 90s, early 2000s. Woodside and Santos have dusted off some old files, and they're now talking as of earlier this week and last week, about getting together and to create a larger company. I think I'd be excited about the possibilities for this merged company. I've liked both of these companies for many years. What I like about them is they're true believers in oil and gas, which means they can hoover up inexpensive assets at a time when the rest of the world is choosing to get rid of those at knockdown prices. And the result is a superpower that I think can re-rate quite nicely. Let's talk about that.
Stu, where would they sit if this deal happens? Where would they sit in the global scheme of things compared to, say, Shell and the big ones?
It's a top 10 company globally in what they call E&P, exploration and production. So when you've got both upstream and downstream assets in oil and gas, you call an E&P company. This company would have both of them. Frankly, it's not as well known as the companies you just mentioned for the reason that it's outside the top 10. This jumps them into the top 10.
All right.
So what's going on? 52 billion US. It's actually worth about $80 billion Australian. It's happening at a time when you would have seen on the news the COP28 meeting is happening in Dubai. It's no secret that the chattering classes and the wokes who control a lot of our not just the government, but major companies and major investing institutions hate oil and gas. And they're therefore able to part with those assets at a very low price and not get howls of protest from their shareholders or other interested stakeholders. The merged company, if you put Woodside and Santos together, has assets all over the place. Alaska, the Gulf of Mexico, PNG, Senegal and West Africa, Trinidad in the Caribbean. So it's a global company, not just focused on Australia. It will be a powerhouse in LNG. Now, we saw when the shooting started in Europe last year how important LNG was to the future of energy. Companies were scrambling to get every single ton of LNG they could lay their hands on, countries, I should say. And I think the LNG boom has got a lot of firepower to it. And it's fair to say that if Woodside and Santos get together, this won't be the last deal they do, because the cash flow they get from being a merged company like Woodside and Santos would turn into would enable them to continue growing from here. Right.
So speaking of woke, Stu, people have been talking about peak oil for a long time. So when is that happening? And also, when's peak LNG expected to happen?
You and I will live to see it, probably in the 2040s. Basically, demand for coal is going down. Demand for oil and gas is still increasing. If we're on a trajectory to transition our energy over to involving less carbon, and that's a real thing, it will happen gradually rather than all at once, which is what you'd come to expect if you watch the evening news with too much enthusiasm. So yeah, peak oil, I reckon, is probably, some people are saying the 2030s, others are saying the 2040s. It certainly isn't the 2020s where we are now.
Right, and LNG being a transitional source of energy, I suspect might be a bit later than that.
Could last a little longer. I believe our grandchildren might live to see peak LNG.
Right.
See, you've got to understand the thing about gas. Ordinarily, you need pipelines to ship it around. At least ordinarily, historically, you needed pipelines to ship it around. Germany found out the downside of piping in its gas from countries like Russia last year, and suddenly had to scramble to find alternative sources of supply. LNG means you freeze gas down to the stage where it's liquid, and then you can move it around the world without pipelines. Just put it on specialized tankers, and all you need at the other end is a specialized terminal at the other end to take the gas. So countries that are looking to get more gas but don't want to have to link up their pipelines to disreputable countries like Russia or Turkmenistan, LNG is a thing for them. It's been a company maker for Woodside since the 1980s, and you'll see other companies doing it. We talk in this slide about PNG LNG. Santos is a big player up here. Papua New Guinea is turning into a powerhouse of energy because of its vast resources of gas in the southern highlands of that country. There's already an LNG project up and running. Santos is part of a consortium that wants to build another one. And the PNG government, they've been monkeying around with the various parties looking for a greater share of the resource for the people of PNG. And that's fair enough. But they want this asset to go forward. I don't think the government of PNG under James Marape could be classified as woke. So I'm predicting that we'll see a final investment decision to the satisfaction of all parties on PNG LNG next year. That would be a big growth asset for this company. Meantime, the two companies can quickly strip away something like 200 million in cost savings. They're already pretty competitive on a cost basis. And here's another important thing: they would be huge players in the gas market domestically. About a quarter on the east coast, about a third on the west coast. The gas prices are still pretty high historically because we just need a lot of it, and there hasn't been many new gas fields developed. It's a little bit unpopular for left-wing governments in Australia to develop new gas, but I've got news for them. We're running out of the stuff, and industry needs it to keep going and actually be competitive from a cost perspective itself. So you're going to see measures to make sure that gas supply stays steady, and this merged company will be quite a player in that regard. So I think that can be advantageously played to once the two companies get together. Let's look at the commodities themselves. There's Brent crude, trading at about 70 a barrel. And if you look over that decade-long chart, that's about the average. A lot of new projects are economic if you price them at 60 for Brent. Now, we had an unusual bear market in 2020 when the world economy froze up post the start of COVID. Took a while for that to correct itself because the correction walked into the energy crisis we had at the start of the Ukraine-Russian war. Things are normalizing. But it's fair to say that if we were if we'd hit peak oil and we were going down, that chart would be pointing in one direction and it would be headed to $20 and below. We're nowhere near that at the moment. Same deal with gas. You'll see it's trading along closer to the bottom of the top end of the range of the last 10 years, but that's distorted by the big 2000 to 2022 bull market that, again, had a lot to do with what's going on in Europe. I think what we're seeing in oil and in gas is a normalization back to business as usual. In this case, about $2 per BTU for that's the Henry Hub, which is the benchmark for gas worldwide coming out of US supply. US has been the swing producer, able to ship a lot of gas globally. So if their gas industry is in good shape, then the rest of the world's in good shape. And what this is telling you is the gas producers aren't making out like bandits, but they're not suffering either. Put those two charts to one side and consider what can happen when Woodside and Santos get together. They're trading at about 3.5 to 4 times earnings. If you're Exxon, Conoco, Chevron, you might get 6 times. So the bigger you get, the higher multiple you get. As I said before, everyone thinks oil and gas is a sunset industry. I've got news for them. The sun will set, but that's coming decades ahead. As I noted before, the merged company gets the upside from the final investment decision on PNG LNG, for which I think the PNG government will come to the table. Meantime, Woodside and Santos have some projects which they've had some trouble with, but if they can get over these, that's another couple of growth assets. One's Scarborough for Woodside. That's got to do with final approvals, often related to environmental issues. Santos has got to go back and talk to the traditional landowners for its Barossa project, but those two projects are not dead and buried. So there's the potential for those projects to go ahead. As I noted, this merged company becomes a top 10 producer globally, so it gets into that elite table of companies that we will know. I've been watching both of these companies heavily. Now, I admit it runs against the grain to talk about oil and gas assets in such a positive light, but we're passing through unusual times where people think that you can just switch on renewable assets with the flick of a switch. Doesn't quite work like that.
All right, good stuff. And actually, Stu, if this is becomes a top 10 company at those multiples, there's a good chance once that merger is digested, it will be well and truly on the radar screen of some of the majors, I suspect.
Yeah,
being acquired at higher multiples too.
One thing I should have added as well is gas is a little bit controversial in Australia, not just from the from the greens. It's the price. So the regulators are going to want to look carefully and see that there's no reduction in competition for the gas market. It's also worth noting that the government has actually capped the price. So it's not an ideal market to be in, but for a country that's still fairly reliant on gas, Woodside and Santos will be sitting in a great position.
Well, even with these capped prices, I find myself shocked at my gas bill every month. It's
right. You and me both.
Anyway, interesting story. And so, how long is this going to take to play out too, in terms of shareholders approving all that sort of stuff?
I reckon we'll be talking about it possibly middle of next year.
Right.
Now, do you reckon any of the viewers are still stuck with us after we've talked so enthusiastically about oil and gas for the last 10 minutes or so?
Hope so. Because we've got something interesting. We're talking about the NASDAQ now, and breaking down the opportunities in the semiconductor space, but also life sciences space. Because as you know, NASDAQ is built up of a range of different companies, and there's a few various indices that sort of represent the health of the relevant subsectors there. So let's have a look. Because we think the good times are almost here again, and so we'll have a quick look at what's happening in those two subsectors basically of the NASDAQ. So about a month ago, more or less 4 weeks ago, we had this chart. I'm not sure if you remember this one, Stu, but the conclusion basically was because the NASDAQ is breaking out of the downtrend, it's probably good to load up on cheap stocks, cheap, quote unquote, because one person a value investor might think it's really expensive, while growth investors say, well, look, this is really cheap. So it depends on the metrics that you look at. But because we'll likely see interest rates come down next year, and the rate at which that will happen, that's still open for discussion, because you may have seen the overnight CPI numbers in the US, in line with expectations, not really coming down very much so far. So we'll see what happens there. But at some point, these interest rates will be lowered, and in that sense, it's probably good to load up on cheap stocks. So in semiconductors and life sciences, especially life sciences, as we'll see, and then looking at what's happened since then, we've definitely seen the break of that downtrend has been that's actually happened. It's probably from a technical perspective, you might still want to see this breakout confirmed. So it could either fill that big gap there in the circle that you see there, and there's a few breakaway gaps below that actually. I'm not sure those will be filled, but there's a good chance that we'll see that big gap filled. And the target for NASDAQ Composite could be sometime in 2024, could be more than 15,800. So that's still some ways to go, because right now we're at the recent peak of July. But if you were to zoom out this chart, you can see that we've been higher before that. So we'll see what happens. For now, we set a new high in 2023. But if we break it down into semiconductors and life sciences, we'll see two different pictures actually. So the Philadelphia Semiconductor Index is an index for, as it says, for semiconductors. There's a whole range of different companies in there: equipment, fabless, IDMs. So it's all in there. And what you can see is that the all-time high of January 2022 was close to 4,100. And we're now, after a recent rally, we are close to 3,900. And the interesting thing here is that it's driven by across the board, with one big exception, NVIDIA. So if you look at the breakdown of what's driven this, it's the fabless chip companies. Chip equipment stocks have done well in the last couple of weeks, but NVIDIA has really been lagging. So if you look at the chart on the left here, this is the chart from November to now, relative to the Philadelphia Semiconductor Index. You can see NVIDIA lagging, and of course, stock has had a massive run since the start of the year, more than 200% gain, and it's now really taking a breather because it's had a massive run, first of all. But secondly, there are some issues, of course, with China, where there are more and more restrictions on what Western companies can export to China, and part of that is AI chips or AI-enabled chips, or dedicated for that. And NVIDIA's got its newest AI chip out, but also for the older ones, there are now restrictions on what can actually be exported to China. So that's putting a bit of a damper on the share price recently. But if you look at the semiconductor space in general, especially the memory sector is starting to pick up now. As you may remember, around July and August, we still saw massive negativism, negative views on inventory corrections, inventories having to be corrected, prices coming down still. But now in just the last 2 weeks, we see completely different news. So for instance, Western Digital, which is pretty big in hard drives, but also in flash memory, has informed its customers that probably prices will rise by about 55% or more in the next couple of quarters. And this is true for flash, but also DRAM has seen a turn in pricing. So that's positive. And 2023 was a very weak year for chip equipment companies, with sales contracting 6%. It's according to the latest data from Semi that came out last night. So back to 100 billion US. But what they're saying is 2025, up to that point, we'll see a 23% increase. So next year and the year after, in total, will be an increase of 23%, according to them. With 2024 still being sort of a transition year, because now the jury is still out as to how quickly the recovery will take place. But 25 should definitely be a boom year. And of course, that in itself is good for valuations. But as we've talked about many times, interest rates, when they start to come down, that will be a clear indication that valuations should be going up as well. So in the semiconductor space, it's already had part of a new rally in anticipation of the boom times. And we've always said, if you follow our webinar, that this industry, this sector, semiconductors, always looks ahead 9 to 12 months, actually, a lot further out than the average market horizon, which is more like 6 months. But then looking at biotechnology, the NASDAQ Biotechnology Index is actually still in a downtrend to it. And I think we need a few catalysts for this sector to break through that. And so you've looked at this, and there's a few things that you've commented on that we need to see happen before we can break that downtrend.
The year was actually not a bad year. We saw a lot of acquisitions by Big Pharma in the billions. I've cited 2 of them there. AbbVie, the old Abbott drug business, bought Cerevel. Roche bought Carnot Therapeutics. When you look at the amount of activity, including some mergers that the Federal Trade Commission looked at and decided to wave through, what you're seeing is a lot of activity. No surprises there. In the bear market last year, and in fact in the year before as well, companies were going in many cases below cash backing. So you had these huge pipelines of interesting deals that could be done for virtually no cash down. We're seeing less of that now, but I think that kind of M&A activity will drive 2024 and help to propel the NASDAQ Biotechnology Index above the downtrend that Marcus highlighted there. There's also a fair few companies that have got more than one phase 3 success coming, and I've highlighted Ionis Pharmaceuticals there. Ionis pioneered the field of antisense drugs, which was pretty unfashionable when Ionis was started. These days, it's getting easier because the technology's moved into the mainstream, and they've got a few phase 3 drug trials that'll read out data. I'm also expecting a lot of the companies that are kicking around in the CAR-T space, and I refer you to Prescient Therapeutics, the Aussie company that Pitt Street Research did some work on. That'll give you a sense of the massive amount of activity going on in CAR-T, which is that new generation cancer immunotherapy. We'll see a lot of developments in that space that could drive value as well. So, I think if that downtrend breaks before Christmas, it's going to be a wonderful January at the JP Morgan conference to kick off the year, and 2024 could end up being a good one. It's also worth noting 2024 was an election year in the US, and biotech's very much a US industry. Admittedly, it's global, but it's been driven primarily by the US. This will shock you, Mark. I'm going to say something negative about Donald Trump. Trump, one of Trump's big platforms when he was president before was controls on drug prices. He was generally a free market kind of guy, but he could see that drug prices were getting out of control. When you start talking drug prices, it's bad for the for healthcare and for biotech, because a lot of its growth depend on very generous pricing for drugs that cost billions of dollars to develop. So what I'm concerned about is that if Trump gets ahead of steam in the polls, and obviously he's doing quite well on the Republican side, but if he starts knocking Biden around, you might see some weakness through the course of 24, if indeed he's the candidate at the other end. and anything could happen between now and then. That might put a damper on what I've just spoken about here.
Right. So you're actually saying you prefer Biden over Trump when it comes to this sector.
Let me just
I
grip
never
my teeth there for a
thought I'd
second.
live to see today, Stuart.
Interestingly, I mean, one of the things I've seen in this sector is anything that encourages drug development tends to get bipartisan support. So go way back in time, the original Patent Term Restoration Act, Waxman-Hatch of 1983-4, that was passed with bipartisan support. So was the introduction of the Orphan Drug Act in '83. And there's been numerous other developments. Whenever Congress says we want new drugs because the public are demanding them, they tend to do things that make it easy for companies to get over the line. In one sense, it doesn't really matter. People realize that biotech is an important part of the 21st century economy. What you don't want is someone going off the deep end, as I say, on drug pricing. And if you want to look at this superficially, it only gets worse. Like we're talking drugs that cost $500,000 per patient per year. Now, admittedly, these are many cases for orphan drug conditions where the actual overall impact on the pharmaceutical budget is small. But Trump has realized in the past that campaigning against high drug prices is a winning issue. So watch out for that.
All right. And yeah, just to remind people that the Prescient Therapeutics report is available on the Pitt Street Research website. The address is right there. And on that note, Stuart, I think we should wrap it up. And thanks everyone for watching. We'll have one more webinar next week, and we'll take a break after that.
All right. Stay well.